Welcome back to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at MarketSite is Sean O'Hara. He's the president of Pacer ETFs. We're going to look at the newly launched ETF VETS. Thank you very much for joining me at MarketSite.
Thank you.
We'll just hook up over different cities around the country and do interviews together.
That's right.
But tell us about the VETS index and the new ETF.
So it's really an interesting story. The Military Times really embarked on a project to create awareness for what happens to veterans when they come back from service. And so they created a survey to try to bring awareness to the cultural issues, hiring, training, how they deal with people on family leave. And out of this survey, they built a ranking system on how well companies treat the veterans. And the interesting thing there was that there was a lot of interesting things that came out of it, but they believe that companies who treat veterans actually will do better over time. I think it's sort of a worker productivity thing. And so they compiled this list into an index, which we just recently licensed and is listed here on Nasdaq. The ticker's VETS. And so it's the basic fundamental premise is that these are all companies who have a very active program in place for hiring, training veterans. They treat their families well. They allow for good leave. And we believe over time these companies will do better than the broad market indexes. And then at Pacer, what we're doing to kind of add to the story is that we're taking 10% of our management fee and we'll contribute that to a military-friendly charity.
Oh, it's fantastic. It's the least the companies can do for the service.
I mean, look, we don't have anything without our veterans. There's a great story, by the way. If you want to know what a veteran is worth, look at what happened last week with Southwest Airlines, right? So the airplane in the middle of the air, the engine blows up, and who's at the cockpit but a former Navy fighter pilot? And it's that kind of character, if you will, that training and that preparedness and the type of person that you get who's formerly military that adds to a company's overall strengths.
Wow, that's fantastic. Well, let's talk about the bull market ending, because as we're sitting here today, it's Tuesday, April 24th, and the major averages are down well over triple digits on each one of them. What happens if this bull market ends? We're going into nearly a decade.
We're fairly long in the tooth, I guess, on a number of years, although we're not certainly at the longest bull market ever. I think people need to start, asking themselves these questions. What happens if the market were to go down 30%, would I be okay? Or 40%, or God forbid we have another correction or bear market like we did in 08 and 09 where it goes down 55 or 56%. These kind of environments are perfect for us at Pacer ETFs because a lot of the product that we build is built with this in mind. We use a trend following methodology to build ETFs, and there's 4 of them. One is on the Nasdaq 100, which is PT&Q, and essentially what we do is we'll own the index if it's above its 200-day moving average, which has been a really resilient thing for the market to break through. It's been bouncing off of that, if you will. It's a good inflection point. But if it were to go below the 200-day moving average, we would start to move the portfolio to Treasury bills so that we would be out of the way, and if the market continued to fall, at least we wouldn't fall anymore. And then we use the 200-day moving average as an entry point on the way up as well. So if the index goes back above, you'll own stocks again. And so we like to say that we want to own stocks, or the Nasdaq 100 in this particular case, when it's trending up, and we want to be out of the way when the trend changes to the negative. So I think that's number one. Number two is I think we need to start looking at valuations. I mean, everybody looks at broad market indexes in the ETF space. We don't generally do that. There's plenty of people that do that. There's real value in that. But what we tend to do is different things. And so we screen for free cash flow yield on a whole other series of ETFs. And what we're trying to do is get excess return over time on the upside, but have a better downside capture. And having a quality measure like a high free cash flow yield will do that. Plus you get a little lower PE given the nature of what free cash flow means to companies. So if you're concerned about what's going on, start to look at your portfolio and stress test it now. The worst time to stress test it is after. What's your risk appetite look like? Can you build portfolios that'll help you deal with the risks so that you're prepared? Because we will have another bear market one day. I don't think it's anytime soon personally, at least I hope not, but we will.
Well, let's drill down to wrap up here. What about the tech sector? Because that really was leading the way for 2016, 2017. And as you had mentioned before, you can see with the NDX momentum looks as if it might be changing for 2018.
There's some big component parts to the Nasdaq 100 that are huge market caps. And I think they're probably weighing on the broad market indexes. It's sort of what has been the end result of this big run-up in stock prices. You've created a bunch of big behemoth companies like Amazon, Facebook, Netflix, and Google. There are names in the tech sector that are not trading at such a lofty level, like I talked about free cash flow yield, and we look at that. the chip makers actually are more interesting to us from a tech perspective today because they're not, there's a Facebook hangover on the technology sector. Will they be able to continue to generate the ad revenue? But the inside of technology is going to continue to grow as the Internet of Things continues to grow. So I would have two comments on that is look for tech names that are not necessarily in that big five, if you will. Look at the chip makers like Lam Research, who's been a terrific stock, generates a lot of free cash flow, huge free cash flow yield. Sales have been going up great. Or use something like the trend pilot on your Nasdaq, where at least you know you're going to have a definitive exit point. If it goes below its 200-day moving average for 5 straight days, you're going to go to the sidelines and sit in the safety of Treasury bills.
All right. Well, thank you very much for joining us at Market Day. It's great to see you.
Thank you.
All right. And traders, thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.